A person earning $300,000 a year can be financially weaker than someone earning a fraction of that. And the reason has almost nothing to do with income. Because earning more money and becoming wealthier are two completely different games. And once you understand the difference, the way you look at your paycheck may never be the same. We've been trained to think that the solution to financial problems is simply to earn more. Get the promotion. Take the higher paying job. Work more hours. Increase your salary. And yes, income matters. You can't build much financial security without some level of income. But here's the problem. A high income can create the illusion that you're wealthy long before you actually are. Imagine two people. Person A earns $300,000 a year. Person B earns $100,000. At first glance, Person A appears to be 3 times more successful. But now look underneath the income. Person A lives in an expensive neighborhood. They have a large mortgage, 2 expensive cars, private school or university costs, frequent luxury travel, subscriptions, insurance, taxes, and a lifestyle built around maintaining appearances. Person B earns much less. But they keep their housing costs under control, avoid unnecessary debt, invest consistently and continue increasing their assets. Who is actually wealthier? The answer isn't determined by the size of the paycheck. The first difference is cash flow. High earners often have more money coming in, but that doesn't automatically mean they have more money left over. Consider someone earning $25,000 a month. If $22,000 disappears every month through taxes, housing, debt payments, transportation, lifestyle spending, and other obligations, their financial position may be far less impressive than their income suggests. Now imagine someone earning $10,000 a month who consistently lives on $6,000. They have a completely different relationship with money. The important number isn't only what enters your bank account. It's what remains after your lifestyle consumes it. And this leads to one of the most powerful traps in personal finance. Lifestyle inflation. You get a raise. So you upgrade your apartment, then your car, then your holidays, then your wardrobe, then your restaurants, then your subscriptions, then your expectations. The strange thing is that lifestyle inflation rarely feels like overspending. It feels like progress. That's what makes it dangerous. Your income increases, but your definition of normal increases with it. But why does this happen? Because money isn't purely mathematical. It's psychological. When people earn more, they often begin comparing themselves with a new group of people. The person who once felt successful driving a $30,000 car starts comparing themselves with someone driving a $70,000 car. The person who was comfortable in a $2,000 apartment begins looking at $4,000 apartments. Your reference point changes. And suddenly, yesterday's luxury becomes today's standard. Now we get to the difference that matters most. Wealth is connected to what you own, not simply what you earn. A salary is income. A business that generates profits can be an asset. A diversified investment portfolio can be an asset. Real estate can be an asset. Intellectual property can be an asset. Ownership in productive companies can be an asset. The key question changes from, how much do I make? To, what is my money building while I'm not working? There's another problem with relying heavily on a salary. Your income may depend on one employer, one profession, or one market. That doesn't mean employment is bad. A strong career can be one of the most valuable financial foundations a person can build. But financial strength comes from what you do with that income. If every dollar depends on your ability to keep working, then your financial system can become fragile. The goal isn't necessarily to quit your job. The goal is to gradually build a financial structure that doesn't depend entirely on your next paycheck. There's also a difference between earning money and structuring money. As income rises, taxes, benefits, business structures and investment decisions can become increasingly important. This doesn't mean wealthy people have some secret tax code that ordinary people don't know about. It means financial structure matters. Where your money sits, how you save it, what you invest in, how you manage debt, how you protect your assets, and what professional advice you use when your financial situation becomes more complicated. The bigger the financial picture becomes, the more important the structure becomes. Then there's something money cannot directly buy back. Time. A high-paying career can be financially powerful. But if your lifestyle requires you to work constantly just to maintain itself, you've created a strange situation. Your income is high. Your expenses are high. Your obligations are high. And your freedom may still be low. This is why wealthy thinking often focuses on leverage. Leverage can come from capital, technology, people, systems, intellectual property, or businesses that can operate beyond one person's direct effort. This is where we need to separate two ideas that are often treated as the same. Being rich can mean having a high income or being able to afford expensive things. Being wealthy is more closely connected to financial resources, ownership, and resilience. Someone can look rich while being heavily leveraged. Someone else can appear relatively ordinary while owning substantial productive assets. That's why judging wealth from appearances is so unreliable. The car tells you what someone bought. It doesn't tell you what they own. The house tells you where they live. It doesn't tell you what their balance sheet looks like. So what should you actually do if your income starts rising? First, don't immediately upgrade everything. Give your income increase a job before your lifestyle gets one. Second, build an emergency reserve appropriate to your circumstances. Third, eliminate or control expensive high-interest debt. Fourth, invest consistently according to your goals, risk tolerance, and time horizon. Fifth, focus on acquiring productive assets rather than simply collecting expensive possessions. And finally, keep increasing your ability to earn. Because the strongest financial position isn't built by choosing between income and wealth. It's built by using income to create wealth. Think about your financial life as a system. Income is the fuel. Your spending is the consumption. Your savings create a buffer. Your investments and productive assets can create long-term growth. Your skills can increase your earning power. And your financial decisions determine how efficiently the entire system works. If you increase the fuel but make the system less efficient, you may not move very far. But if you increase income while controlling lifestyle inflation and consistently building productive assets, something changes. Your money begins working toward a larger objective. Not just a better month. A stronger financial future. And maybe that's the biggest lesson. The goal isn't to make less money. The goal is to stop confusing income with wealth. A higher income can give you more options. But what you do with those options determines whether your financial position actually improves. You can use a raise to increase your lifestyle. Or you can use part of it to increase your financial resilience. You can spend every bonus. Or you can turn some of it into ownership. You can spend decades chasing a bigger paycheck. Or you can gradually build a system where your income, assets, skills, and decisions reinforce each other. If you're serious about building wealth instead of simply earning an income, my guide, the Billionaire Wealth Blueprint, explores practical strategies for building multiple income streams, protecting your finances, and thinking more like long-term investors. You'll find the link in the description and profile bio. So the next time someone tells you that the secret to wealth is simply making more money, remember this. Income is what you earn. Wealth is what you keep, own, build, and protect over time. And the difference between the two is where most people never learn to look. If you want to go deeper, watch our next video on why smart people stay broke. Because sometimes the problem isn't how little you earn. It's what your money is being trained to do.